Hello, y'all hear me on Zoom? Put something in the chat real quick. But welcome everybody to another general meeting, another late Wednesday night here. How's everybody doing? Thumbs up, down, midway? Nice. Muy bien, Lisa Sweet. Good. Good to hear. Let's get started here. So general meeting agenda here. We're going to be having our outperforming moments, our internship spotlight, this time from Alex. He's got some great experience to share. Professor Sweet will cover something at the end, and then the society updates. So first thing, our weekly quote. So the weekly quote I chose today was, do something today that your future self will thank you for tomorrow. Yeah, so I like this quote. It's quite motivational. Even if it's small things that you could do today in your personal life, your financial, or like your future career, whether you apply to a job or wash some clothes that you needed for tomorrow, like I did today. So little things. Appreciate the small things. You'll help yourself in the future. So some outperforming moments. Let's get 3 outperforming moments for the week. Yes.
Got a 100 on my calculus quiz.
Yes.
I recently became the SGA College of Business Senator.
All right.
One more. And strong here. Oh, guys. We always suffer at the end. Nobody. Okay. Yes. Thank you.
I have like 105 in my capstone class.
Nice. That's all right. Now let's continue with Juan Carlos for the market outlook. Round of applause for Juan Carlos.
Okay, let's get into the market. We're going to start first do like every single time market recap, and we'll talk about Google earnings, Netflix, Microsoft, Coca-Cola, and then China. So first of all, the markets were doing great. Why were they doing great? A lot of the companies that have reported earnings outside of tech have been doing really good, and they've beat both earnings and revenue estimates. And that's why it's kind of pushed all the indexes up. And it also brings momentum for other companies. So that's why all major indices were up. Coke, General Motors, Visa, and Chipotle all beat earnings. And this is a great statistic. Going back like 50 years, 66% of companies in Q3 beat their earnings. And so far by Tuesday, 71% of all companies had beat their earnings estimates. Also, like we were talking, bad things happening in the economy is good for in terms of not increasing interest rates. And house prices in the largest 20 cities declined 1.3% when they were obviously increasing before. And then the consumer confidence index, this is important because we'll talk about this in both Google and Microsoft earnings. But the consumer confidence index decreased in October after increasing in August and September. And these are some of the things the consumer confidence index looks at: buying intentions, vacation plans, consumer expectations on inflation, stock prices, interest rates. It basically looks at what are people thinking and how are they going to spend their money. And then this is a quote from Paul Semsky, Chief Investment Officer. He said, "We're seeing enough slowing in the economy that we don't have to worry about the Fed really raising rates beyond what's already priced." That's his opinion, but that's ideally what we want to happen. So let's talk about Google earnings. So Google missed on earnings, and they also missed on revenue, which is obviously not good for a tech company. Because also on Tuesday, I think they reported earnings. The markets were green, everything was going well. And then they reported after close, and all the futures turned red because obviously Google had reported and they were negative. Google Cloud revenue beat earnings, and that was the only good highlight from them. YouTube revenue missed. Not only did they miss, but they made less money than last year, which is not good. They also reported 13.9 billion in net income, a decrease of almost 27% from last year. Like Microsoft and Google, the same thing. Currency fluctuations are not only big for tech companies, for Coca-Cola too, but they've been able to go through them better. But currency fluctuations still are a big thing for them. And this is like the chief business officer for Google. He said that the biggest ad spend that was lower this time was insurance, loans, mortgage, and cryptocurrency. So those areas spend less on advertising this time. And that goes back to consumer confidence that is lower. And additionally, Apple's new restrictions on tracking users not only affected Google, it's affecting Google less than Snapchat and Facebook, but it's still affecting Google because Apple's restrictions basically disable or like it makes so they can't take enough information from their customers and then obviously sell it. Netflix earnings, as we all know, Netflix went down like 60% because they were losing users instead of gaining. And they guided for 1 million users for Q3, and they beat that, and they also beat earnings and revenue. They added 2.4 million users after losing users for 2 consecutive quarters. And even then, so they had added 8 million the quarter before they lost. And after they lost, for some reason, they weren't a good company anymore, and they lost 60% of their value. Now they're obviously, they gained 2.4 million users, so now the stock's going back up, but it's obviously not at 600 like it was before. Some of the things they're going to do in the future, they're coming out with a subscription tier for $69 with ads, which they hope to make good money from it. And they also want to crack down on password sharing. By doing this, they are going to implement so you can add more users into a Netflix account for like a small fee. But that's just in the initial stages. Now let's talk about Microsoft. Microsoft beat everything, but they also beat it by like a really slight margin. Google didn't beat anything, but Microsoft did it by a slight margin. Personal computing was up, productivity was up, and intelligent cloud was up. And obviously, we have the CEO that's happy there. But one of the big things about companies is not only their performance for the quarter, but their outlook. And their outlook wasn't good. That's why the company was down 7% after hours. So next quarter, they expect lower growth in personal computing and intelligent cloud. They were talking about PC computers. They saw less demand in September, and they see less demand going forward. And that goes back to the consumer confidence index. The consumer confidence index went lower as potential sales by Microsoft. Intelligent cloud previous estimate growth is down by 5%. And again, currency fluctuations to lower overall sales growth by 5% too. But not everyone's doing bad. We have Coca-Cola. Coca-Cola beat earnings in revenue too. And last week we were talking about banks, and banks doing good whenever interest rates go up because they make more money in net interest income. The same with oil companies that manufacture oil when oil is really expensive. The same thing with Coca-Cola, but in this case, their ability to push costs, inflation costs to consumers is what makes them money. This summer I was listening to a podcast, and there was a manager that was saying he would go into consumer staple stocks if they were successfully able to push costs of inflation to consumers, which is obviously not ideal for consumers. They're spending more, but if a company can throw those costs to consumers, it's good for those companies. And Coca-Cola is one of them. They raised prices multiple times already to make up for higher costs. Average price of Coca-Cola products have gone up 12% year over year, while inflation has gone up 8%. So they've taken advantage of it. And they also said that demand is really high. And lastly, one of the things they say they want to do for consumers is they basically want to sell the same products for the same price they were selling them 2 years ago. But now if you buy a liter for $5, now you're buying a liter. Now you're buying 800 milliliters for $5. You're buying less for the same price.
Happens to their sales growth. Buffett guys.
I don't know. That's why I put Buffett there, because he helps them a lot. And they also increased their target growth for this year from 12% to 14%. Now let's talk about China. So Xi Jinping won for a third time the position for president of the People's Republic of China. And he did something that kind of collapsed all the Chinese stocks. So in China, there's what is called a Politburo, which I think is also, in Russia. But basically, he has 7 leaders, which cover different areas from the military to economics, finance, and stuff. And he fired 3 of the finance ministers and economic ministers and added 2 spy chiefs and a military leader. And basically, for his goal of unification with Taiwan. And this is how the market reacted. This is an actual video. This was the guy that was fired. And China said that he was sick, and that's why they were taking him away, but it doesn't look like he was sick. It looks like he was like, take me away. But Yeah, so the Nasdaq Golden Dragon China Index dropped 14% to its lowest close since April 2013. Another Chinese index was down 15%. And then there's one thing really interesting. Alibaba traded at $58, lower than its IPO price of $68 in 2014. And during the pandemic, Alibaba was trading at $330. So that's a kind of big collapse in the Chinese markets. China's currency also hit its weakest level against the US dollar in more than 14 years. And this is what BlackRock thinks is going to happen with China. So they're saying China will go through a slower growth phase. And they're also trying to build their own technology. And kind of that's why they're still ruling out Facebook and all those companies. They want to do it in-house so they can. They also, I mean, China also said they wanted to be the #1 country by military and influence by 2050. So I guess by doing the spy chiefs and military, that's probably how they're going to achieve it. But yeah. That's it. If you have any questions regarding the internship prep, feel free to ask me. And with that, Alex.
Alrighty. Today we got the internship spotlight. What I'm going to go over today. I've got some other stuff: GDP now, the housing market, and the U.S. budget deficit. All right. So this past summer, I interned at Gray Street Partners. Right. So that's a real estate private equity company here in San Antonio. So I was basically running due diligence on real estate, across America. I was building financial models as well on several different types of asset classes. We had office, multifamily, parking garages, retail, redevelopment, and development as well. This picture is one of the projects I worked on, right? So this is a parking garage in St. Louis. So I was tasked with was kind of figuring out the area. So I had to figure out, the traffic in the area, the apartments in the area, the offices in the area, and any new developments that might be happening in the area that they would use this parking garage, right? So this parking garage was kind of beaten up. So it's kind of a higher on the risk spectrum, right? If any real estate guys know, it was a value add opportunistic property, right? The cash flows weren't strong. So it was a little bit riskier. So I had to do all that due diligence and kind of report it to the MDs and then kind of figure out the growth aspects and put it into the model. And that was kind of what I was doing for that project.
Which building is the parking garage?
It had a parking garage on the top, and the previous owner converted the first floor into a gym. So they had a gym and a parking garage on the top.
And those are parking garages?
Yeah.
That's crazy.
Yeah, it was a weird building. But these are other two deals I worked on as well. So the left one is a building in Houston that was leased by McDermott, which is a oil and gas company. And then the second one is the middle building. I put my cursor right here. It was this building right here in Dallas. And that one was an office building that they were converting into multifamily and hotel, right? So I kind of got some good experience from that. The office building in Houston, Dermot one, I kind of did what investment bankers might be doing, right? Because this was a company that went bankrupt in 2020. And so it's kind of a very risky deal. No one really wanted to touch it. And so I was tasked with kind of figuring out their financials, right? Why they went bankrupt and how they came out of it, the projections for future growth, revenue growth. And so I was kind of doing all that and kind of figuring it out and making a presentation about it for the MDs, right? So I had that, and just to say, I kind of came into this internship in an untraditional way. So it was like March of last year, my sophomore summer, and I didn't have an internship yet, right? So I didn't have an internship by May either, and so I was kind of, for any of you guys thinking you're late right now, you're really not late, right? So this internship I found by going on a website, right? I put real estate private equity companies or private equity companies, and I started emailing and LinkedIn messaging all the top people in that company to figure out if I can get an internship with that company, right? So I LinkedIn messaged one of the MDs here, and he answered. He set up an interview for me. I interviewed and I got the internship, right? If I wouldn't have gotten this, I wouldn't have done anything for the summer, right? So it's always worth figuring out, if you don't have anything yet, looking at smaller companies, maybe emailing them. Experience is experience, and you need to be doing something over the summer, right? So that helped me get my next internship this next summer. It's going to be with Heitman, real estate investment management company. It's going to be in Chicago, so I'll be in their acquisitions team, in real estate acquisitions team. So I'll be in this building, where the cursor's at right here, next to the Nuveen building. I'll be in that building in Chicago, so it's gonna be a fun time. So now GDP now, right? So this is a track by the Atlanta Fed. They release it's kind of a running estimate of GDP. So they kind of GDP growth, of real GDP growth. And so they track it daily. And right now it's saying that the current estimate of GDP growth is 2.9%, right? So it's saying that we're going to be growing for Q3. And the accuracy of this, it gives an average absolute error of 0.83 percentage points and a root mean squared error of 1.23 percentage points. But it hasn't been as accurate, or that accurate in the past. It's fairly close. Recently, since COVID, it's kind of been kind of very off compared to other years. As you'll see here, it's kind of, this is the green one is the GDP now estimate, and the blue line is the blue chip consensus estimate. And that's kind of from like the analysts and economists that they give estimates for that. So you can see that they're kind of very off in these estimates, right? Economists are not always right. So usually never right. So it's kind of a bad thing, right? So now we get the housing market. So there was a report that came out that builders are stuck with extra supply, right? They're offering discounts to investors, discounts on sale on their bulk sales to investors, right? So these discounts range from 10 to 15%. Some are saying where they're even offering 20% discounts for investors to investors, right? So it's kind of crazy. That means that demand is coming down, right? They still don't have a lot of supply. The demand's coming down. As you can see, September housing starts came out last week. Construction of new homes fell 8.1%. The starts on new homes fell 4.7%, and the starts on apartments fell 13.1%. Right, so these builders are kind of realizing that demand is falling, and so they need to stop building and stop starting new production, right, or new construction. So analyzing the housing market, we see that the elevated costs to buy these properties or build on these properties, right, has kind of weakened demand both for building for the supply side, right, and for the buy side. The chart shows kind of the permits from September 2017 to September 2022, and it shows that permits are decreasing, right? Permits are decreasing, starts are decreasing, completions still look like they're going up, but for the most part, everything's kind of going down. So now we got the U.S. budget deficit, right? So Treasury Department reported that their full year 22 budget deficit falls to 1.4 trillion, down from full year 21 of 2.8 trillion, right? So last year they had a huge deficit. This year they're not doing that much spending, right? So they're not giving all that COVID money out, not doing too much spending. Their deficit is not as down as it was before. As you can see from the chart, had the huge drop over here in the bottom in 2021. Now the deficit isn't that bad no more. Still low. I mean, still pretty bad compared to previous years, right? Still lower than pre-COVID, so not that good. They came in with a $4.896 trillion in revenue and 6.2 trillion in outlays. So this is actually their highest revenue year in U.S. government history. So I guess that's a good thing, but they still have more expenses than revenue. So it's not too good, right? I guess people are also paying more taxes now. They did hire, what was it, 8,000 IRS agents. So I guess that's working. All right, that's it for me, guys. If you guys want to connect with me on LinkedIn.
Thank you, Alex. Before I start, I just wanted to say happy birthday to Anna. Her birthday's tomorrow, apparently. So this week, going to talk about Kroger and Albertsons merging. So it's about 24.6 billion dollars of a merger. Kroger is going to become the second largest grocer in the United States, after Walmart. And then, this happens Friday, October 14th, so a couple of weeks ago. So, this is what it currently looks like now. You see Walmart at the top there with 20.9% of the, grocery market share, but that's not quite right because they also own Sam's Club, so they're more at like 25.6% if you count Sam's Club. And then there's Kroger and Albertsons right there for about 10% and 5.7%. So call it 15.6% if they merge together. So in 83 in downtown Cincinnati, Ohio, a man called Barney Kroger spent all of his $372 almost said billion, used to billions, to create a general store. It looked like so, very general store-esque. So, and this was before grocery stores were really a thing. So you come in, you look at the catalog of stuff they have. They come and select all your stuff for you behind the counter. Anyone want to guess what $372 dollars in 1883 is worth today now? After
3.8
inflation?
million.
What was the guess?
3.8 million.
Higher or lower?
Lower.
Okay.
300,000, still lower.
Okay. It's like 30. It's like
150?
$4.
Apparently it's about 10,000. In 1902, Kroger had amassed about 40 stores and $1.75 million in annual sales. Kroger also became the first store with in-house bakeries. So Kroger today, Kroger currently has about 2,800 stores. That counts their grocery stores. They have about 100 jewelry stores and about 100 clinics in 35 states with about 25 banners, which if you don't know what banners are, they're basically like names. So you have Kroger, 420,000 employees. You can see all their banners there. You have Kroger's the big one, King Soopers, which is in Colorado, Fred Meyer. I don't really recognize most of the others.
What is Fry's?
Hmm?
What is Fry's? Is that an electronics store?
Not quite sure. Well, they're all grocery stores. Some of them are kind of the bigger models like Sam's Club, but for the most part, all grocery stores other than the clinics. You can see at the bottom right, not the one on the far right, but the one second to the right, the little clinic. They have about 100 of those, and then the rest are all grocery stores other than the jewelry stores. So their stock today currently sitting at about $45 with a 13.84 PE ratio, which is higher than Meta at the moment, tech company. Dividend yield of about 2.29%. And this is about where they have all their locations. So you can see they're kind of, there's a lot in the Midwest, but they also have some in Texas, West Coast, but Midwest and the South primarily. And then in 1939 in Boise, Idaho, sorry, Joe Albertsons, a former Safeway supervisor, starts his first store with about $12,500 in 1939. Looked like so. Anyone want to play the game of how much that's worth today?
125,000.
Close, 248,000. And then by 1959, they had 100 stores. And in 1969, Albertsons partnered with this company called Skaggs to create the first grocery store, drugstores combined. It was just a partnership. They didn't like merge. They split after about a decade. And then Albertsons today we're sitting at about 2,200 stores in 34 states and DC, 20 banners and 290,000 employees. So there's Albertsons and all their different companies they have for banners. Safeway is in there. Most of the others I don't recognize, but all mostly grocery stores. And then their stock price today, it's at $20.43. With PE ratio about 7.12. You should note that if the deal goes through, the shares will be sold at $34.10, 66% gain or so. Obviously, there's a reason why it's not at $34.10, and that's because it's having some legal issues we'll get into. But if you guys think the deal will go through, could buy the shares and get a 66% profit if you do. So today, Albertsons looks something like this. You can see they're primarily on the West Coast, but they also have some in the Northeast over there and Ohio as well. So what is the combined company? What would it look like on the map? Looks something like this. So you can see kind of spread apart. There's some areas where they have a combined presence, and but for the most part, Kroger is dominating the Midwest and the South over there, and then Albertsons has the West and the Northeast. But of course, there's some combined areas: Seattle, LA, Colorado.
GB's all the way. GB.
So together, Albertsons and Kroger would have about 710,000 associates and operate a total of 4,996 stores with 66 distribution centers, 52 manufacturing plants, 3,972 pharmacies, and 215 fuel centers. The combination would create a seamless ecosystem of 48 states and the District of Columbia. The two states they won't be in would be Minnesota and Iowa. That's Iowa. All right. So there's some backlash for the merger. 3 Democratic senators on the antitrust committee of the Senate, Bernie Sanders, Elizabeth Warren, and I don't know how to pronounce that. We're going to skip that part. Have come out against the merger and called the FTC to rule against the merger. You can see Bernie Sanders and Elizabeth right there. Bernie's tweet: at the time when food prices are soaring as a result of corporate greed, it would be an absolute disaster to allow Kroger, the second largest grocery store in America, to merge with Albertsons, the 4th largest in America. Should reject the deal. And then, so talking about the FTC also came out a couple months ago with a new stance that they are going to litigate, not negotiate, which means if you come to the FTC with a merger deal and it's not right, you haven't given enough you haven't made it fair enough for the consumers, they're just going to strike it down. They're not going to negotiate with you. They're not going to tell you to sell off some of your stores, so then you're not competing with, or you're reducing competition. They're just gonna kill the deal. So 6 U.S. attorney generals for states are calling for a halt for a dividend that's about to happen next month. So some reasons for the backlash as well: raise prices, mostly don't want to increase inflation. That's bad for the controlling party or for all Americans, and be harder in the midterms. So you clearly see Democrats clearly don't want any more inflation. Makes sense. Lowered wages. The two companies both have union workers, and so they'd be able to better compete against the union if they were combined. I guess you could say the same thing with the employees, though. And then $4 billion dividend. It's actually come out, I don't think it came out quite yet, but it's looking like they're going to delay the dividend because the $4 billion they would just pay to stockholders. And this is before the deal goes through. So if Albertsons gives away all of its emergency fund and then the deal doesn't go through, obviously be hard to expand or pay its employees anymore, or if they have any things they need to fix, they wouldn't have any money to do that. So it kind of makes sense that they shouldn't do the dividend before the deal goes through. So what will the deal do to grocery bills? Answer is a mixed bag. Consensus is that overall it will reduce prices, but where the two companies are competing, it may in fact increase prices. So the reason is it'll reduce prices essentially works the same way as a family. You can buy from, HEB or Walmart, just one items if you're a single individual, but if you're a family and you buy a bunch of stuff, you can buy in bulk. So a bigger company can buy more in bulk from producers, and they'll be able to sell at a lower price. They may also be able to increase efficiencies by having the distribution centers send out to closer areas. Maybe you pay less on gas, that kind of thing. But of course, the areas where they do compete, you're getting rid of a competitor. And so you might see some lower prices. So Kroger's actually come out and said they would divest 600 stores and either sell them off to a different company or spin them off. And there's mixed results on if that actually works or if the company will just kind of go under. And so the employees aren't the happiest with the fact that they might get, spun off, or they might lose their job because they closed the stores. But overall, kind of curious to see if the deal goes through. Not quite sure what the FTC is going to do. They're not the happiest about it, but if they are promising the 600 store divestiture, which may be enough for them to let it go through. Then follow me on LinkedIn or connect with me on LinkedIn. And up next is Sweet Spot. Everyone sign in while you're still here.
All right, before I start, I got this email from Bloomberg. Bloomberg for Education is going to start a schedule of upcoming student-focused webinars. I don't know how to put it on Telegram, so I don't know if I can forward it to Anna and you can get it out somehow. It's in an email with links, but I can't tell. There's not a place. But anyway, November 1st, I have one on commodities. November 2nd on equities. I'll probably sit in and see how good they are. They've been pretty good with these in the past. Anyone interested in that? It's like a webinar. Okay, so yeah, I think they're at 11 o'clock. So 10 o'clock San Antonio time. So I'll get them somehow. If I forward them to you, Anna, can you distribute? All right. So here are these three guys. Any guesses? You know the first one. Ben Bernanke, that sound familiar? You probably don't know the second one, and that's what I'm gonna look like in about 3 years. That's Wolverine. He must be a professor. So Ben Bernanke, Douglas Diamond, Philip, whatever. So I thought it was interesting. Every time they announce the Nobel Prize in economics, I'm always curious, who is this person? And how many of them will still be remembered 5 years later? So you've heard Bernanke. Why did they win the Nobel Prize for? Did they, radically change the world? So it said their discoveries improved how society deals with financial crisis and their understanding of the role of banks in the economy, particularly during the financial crisis. Now, this isn't what Ben Bernanke learned after 2008. This is what he published before 2008. So supposedly without him, it would have been much worse in 2008 because he figured all this out when he came in. So what did they learn? Why avoiding bank collapses is vital. That sounds good to me. We should try to avoid banks collapsing. I can go with that. Why we have banks. So they told us why we have banks. You take money in banking, they tell you why we have banks there, right? Borrowers and lenders are brought together. How to make them less vulnerable in a crisis. I think the most interesting thing is why bank prices spread so rapidly to everyone else. And they had some interesting things to say there. Their analysis has been a great practical importance. So they don't really explain what did we do differently because of their research. That would be interesting. What would the world have looked like in 2008 if they'd never been born? What would 2008 have looked like? We would have all collapsed. Cities would all been burned down, I guess. I don't know. But isn't that an interesting thing? What did they actually teach us? What did we actually learn and do different because of them? In regulating markets and dealing with crises, for the economy to function, savings must be channeled to investments. There's a conflict here. Savers want instant access to their money. They want liquidity. While businesses and homeowners, they need, you can't borrow a 30-year mortgage and the bank says, you know what, Tom wants his money back. Can you pay your mortgage off tomorrow if you don't mind doing that? That doesn't work, but Tom wants his money back. You're not going to pay it because you got a mortgage. So how do you handle that? They showed how the combination of these two activities make banks vulnerable to rumors about their imminent collapse. If a large number of savers simultaneously run to the bank to withdraw, obviously becomes self-fulfilling. A bank run occurs and the bank collapses. These dangerous dynamics can be prevented through government providing deposit insurance and acting as a lender of last resort to banks. That's the big issue the Euro countries are having. How do we bank insurance? What amazes me with the FDIC, I just think it's absolutely crazy. Their website a few years ago, you went on their website and they told you how you could take advantage of the system to get more taxpayer bailouts. And as a taxpayer, I was like, why is the federal government telling people? So they said, yeah, the FDIC insures 100,000, but if you make your daughter a beneficiary, you get 200,000. Then you make your son one, and your pet dog, make them one. You can take that 100,000 of insurance, you can make it 800,000. The husband can make his wife a beneficiary. The wife can make the husband. They can get, instead of 200,000, they get 400,000. Their kids. Why is that on the FDIC's website? Does that make sense to you? As a taxpayer, do you want the FDIC to say, hey, free money, free money? How important is it? So Frost has a CD paying 1%, 5 years. How many of y'all would loan Frost money for 5 years at 1%? Anyone in here? If there was no FDIC insurance, what would Frost have to pay you for 5 years without FDIC insurance? 4, 5, 6%. You see how much money that saves Frost? Where does that come from? It's us, right? We make Frost very, very profitable because they get to borrow at 1% where they probably would have to borrow 4, 5, 6%. That's pretty huge. So this is not immaterial. Banks get that benefit. What do they have to give up on the other side? You can debate that. Diamond demonstrated how banks perform another social important function between savers and borrowers. Banks are better suited for assessing bank creditworthiness. So when banks falter, there's no one there to lend out because no one knows who these customers are. So banks have that knowledge of their customer. And that's really true, especially some of these small community banks in smaller cities. Boy, they know their community. They know which store they're going to loan money to and all that. They have a knowledge that just disappears. Bernanke analyzed the Great Depression. We all know that, right? That was kind of probably part of the reason he came when he did. He showed how bank runs were a decisive factor in crisis becoming so deep and prolonged. So that's part of what he's saying is the crisis didn't cause the bank run. The bank run happened and then it spread to the crisis. Well, that's kind of important to know because then you got to say, hey, we got to prevent that bank run. Valuable information about borrowers were lost and could not be recreated quickly. Society's ability to channel savings to productive investments was very severely diminished. So we learned a lot. I don't know what they actually did in 2008 because the FDIC already had insurance. And then in 2008, didn't they take that 100,000 and jump it to 250, just like that? So pretty important. Here's all the other winners. How many of these other winners do you know? How many of y'all know what David Card said? Are y'all talking about these people in your classes? No. Y'all know these people? Their experimental approach to alleviating global poverty. Have they been successful yet?
No.
Is alleviating the same as reduce, or is it completely get rid of? I don't remember the word alleviating. Does that just mean reduce or eliminate? Integrating climate change and long-term macroeconomics. You've heard of him. Good old Thaler. He's the guy who wrote Nudge. He's the behavioral finance person. He got an award. I don't know them. Y'all have heard of Fama. Heard of Schiller. I don't know Hansen that well, but you've heard them. Those two you see a lot. Y'all use the CAPE index, right? I don't know these other people. We know Paul Krugman. The only reason I know Paul Krugman is not because of his Nobel Prize, it's because he's very political, very out there on the press, kind of very partisan. Some other people I've never heard of, other people I've never heard of. Is it possible some of these people came up with stuff that we'll never hear from again and won't ever matter? I don't know. It seems like, what is really important though? What is their university doing? We have a Nobel Prize winner, right? So I need to win the Nobel Prize at UTSA. The chances of that are pretty low. Kahneman, there's one very, very important one. Y'all have all read his book, or if you haven't, you need to read his book very quickly. Merton, Scholes, you've heard of them. Y'all see others you've heard of, let me know. And then we get to the big year. 1990, that was like the most important year ever for Nobel Prize. Y'all have heard of all three of these, haven't you? Markowitz, you know, wow, how many years you have to go before you hear a name again? Markowitz, Miller, Sharp, the three biggies all in that 1 year. It's pretty amazing. And then a bunch of other people I've never heard of. Modigliani, it would have been somebody else as well if he had not passed away. So who's the other person? Blank and Modigliani, y'all know this. Someone knows this. There's no way I have a room of finance majors. You don't know who Modigliani. Come on, see how you're Josh. Miller Modigliani, y'all don't know Miller Modigliani. All right, go look up Miller Modigliani, because if you interview for a job and you don't know who they are, you're in a lot of trouble. Extremely important. And then a bunch of other people I've never heard of. Milton Friedman, one of my favorite people. I saw him once live before he passed away. I saw him at a conference. Hayek. I was shocked Hayek was there because I was thinking he was already dead by 1974, but that's hard for me to believe Hayek was alive when I was alive. That's kind of incredible. Have y'all read Hayek? Road to Serfdom, very important person. And then, of course, the father of finance, Samuelson. Do y'all use this textbook in your classes anymore? It used to be the go-to economics. So, I don't know, you read through some of these titles, and you have to kind of wonder how many of them made a difference, are still important. How many of you are hearing these in your classes? It sounds like, have y'all heard of at least one of these people? Sharp, right? And Markowitz. What else? Thaler. Probably the same ones I've heard of. You're probably not hearing Krugman in your class, but you've probably seen him on TV. So I don't know. It's interesting to me. What I like to do is when they announce it, I like to go read and say, okay, what are they saying that these people did that was so important? And doesn't mean anything to me, because if it's so critically important, I don't know about it, then maybe I need to be reading about it, because, you know. So how would you figure out what these guys said? I don't know. You could probably go out and find their dissertations, these first three, but are they even readable? It's probably high jargon, a lot of maths. So they're economists, obviously they're going to try to scare you off just in the abstract. When I do find something like this that's not readable, I do read the abstract and I do read the conclusion. If the rest of it's all formulas, you know, if I can't understand the abstract, then yeah, I have no hope. But sometimes you're going to see what's the gist of what they're saying. Even if I can't do the math, I can say, oh, when this happens, this happens. That by itself is not bad to know if you're going into an interview. You know, you say, oh yeah, that's what Bernanke was talking about in his research, you know, so yeah, I give you some. So anyway, I guess that was the first year of the economics. It was 1969. So there's the first winners. Have you ever heard of these two guys or gals? I don't know if Jan's a man or a woman. I don't know if Wagner's a man or a woman. But, all right, that's it for me. Thank you.
Thank you, Professor Sweet. Okay. Let's end this meeting off with some updates here. The Market Watch competition is still ongoing, and I'm finally on the leaderboard again. I'm number 9 right there. First place is Raul Medina, right? As of right now, he's here. He was here. Amy is second, and Brian is third place right now. See a lot of people. Yeah, there's a huge jump in the profits here for the top 5 compared to like 10 and 12. So there's that, but still, if you haven't joined the Market Watch competition, I think there's still time. Jump in, put some stocks in, invest, and compete, because the top 3 winners get a cash prize. First one will get 100, and second place will get 80, and then third will get 60. So no risk, high reward. We are selling our polos. If anybody wants to buy one, shortly here, you can feel free to raise your hand, let us know right now so we can still have them out here after the meeting. If not, we'll put them soon. And then another quick update on the t-shirt that won. Y'all remember that graph design stock price, the stock chart, right? We did order those and they'll be here and we'll be selling them in our next general meeting since we should receive them by next week already. And now the fun part, gift card giveaway. Let's have Jason up here. Round of applause for Jason.
All right, so everybody's favorite part. So can I get a drum roll, please?
The first winner.
It is Jair Lugo. Hey. All right, drum roll, please, for the last winner. Joseph V. Nice. Okay, right here.
Congratulations. All right, real quick, who's graduating this semester? Raise your hands. Nice. We got the MDs. Congrats. Huge accomplishment. So I counted 3 right now. Just next semester? Me. Okay, quite a bit more. Okay. So we are considering, well, highly considering, like 90%, having a little ball for the graduates at the end of the semester. It would be on campus here in one of those like ballrooms here in the second floor, right? To celebrate and congratulate those who are graduating and putting in all their hard work and accomplishments with the investment society. So if y'all are interested in that, raise your hand. Like, would y'all attend our ball? Come on. Okay, show some support there. All right.
Is it for everyone or just the graduates?
Everybody, like everybody from the society would be invited. We'll have a little slideshow and probably some more awards ongoing there. Then I would, since we got some time here, I would also like to mention that the Costa Rica trip, I know those who expressed interest early on in the semester, is still ongoing for next year already, early. With that, we would like to ask if anybody would like to donations, be able to donate some things. I know Sweet mentioned to me today for the kids there, we would like to donate toothpaste and toothbrushes. Are y'all interested in like supporting a great cause like that, right? Okay. Not
Do you
too.
have connections with the grocery store that we can get on cheap?
Anybody works at a grocery store?
Even when it has like
Discounts?
fancy. I'd like to think a few hundred.
How much is the Costa Rica trip to go?
Well, for this trip, it's max $500 a student.
Bring stuff out of his bag.
It's not that bad, but it's gonna be our first time back since COVID, so it's a huge one this next semester, but it will be annually. So if you're not graduating next semester, definitely recommend it and support the investment society through that side as well. But we'll continue talking about donations for the Costa Rica trip later on. I think that's about it for today then. Hope y'all have a great night and see y'all next week.